Okay. Well, welcome to the death panel of the day one. Right? And none of us are surprised by the numbers. I hope everyone outside is enjoying their coffee and will join us in good time. This is actually a pretty important panel because we're all talking about supply chain finance and we're all talking about solutions and regulations and things like that. But there is a fundamental problem that exists in the supply chain world, and that's that the estimated global shortfall of trade finance gap was estimated in 2021 to be $1.7 trillion. Now, it's only a matter of time before Accenture or Ernst & Young or Price Waterhouse come out and say, no, it's not, it's going to be over 2, or it's going to be 2.5, or it's going to be 3. Now, banks traditionally have done a fairly good job in of filling up the gap in trade finance needs. But the reality is that global trade is not going to get smaller over time, and banks are also subject to finite limits, particularly with instruments that have a different risk base. So the reality is that we need to see more people involved in providing trade finance and supply chain finance facilities. And currently it's dominated by the banks, but this is not a bank bashing exercise, right? The panel is actually made up of fairly reasonable people. What we want to discuss here is how to create an asset class that is attractive for other investors, particularly institutional investors, with a goal for this to be effectively something that will fill the gap that we're seeing in trade finance globally. And that's the aim of this whole area. Now, banks, of course, should traditionally be unexcited about this because they turn around and say, this will mean that we're going to lose a little bit of our business line. But the reality with this, with the growth in trade that we're seeing globally, is that this actually adds an extra business line for the banks because they're some of the people that will eventually package these package this into investable units that institutional investors are happy with. So we've got a very esteemed panel here. We've got 2 panellists that are remote and we've got 2 panellists here. I'd like them briefly just to introduce themselves and just to tell us which institutions they represent and where. Kaarel?
Yeah, I'm representing the stock exchange. I'm heading Nasdaq Tallinn. Have been doing this for, 6.5 years. And I guess why I was invited here is because people know I'm pretty much of a capital markets fan as well.
Hi, my name's Jason Barrass. I'm actually an ex-banker, but I am a reasonable person. I represent a credit rating agency called ARC Ratings. They're the 7th largest rating agency in Europe. It has all the licenses needed to conduct business and do securitization. We're a securitization boutique house. The reason I'm here today is my years in banking were in trade finance. So I ran various trade teams in Africa, Middle East, and the UK. And now, within ARC, we're looking to, or are, securitizing trade receivables, project trade-related transactions, payables. And so I'm here to really get the flag out and try and do an education process around how this wonderful asset class can be introduced to alternative investors.
And Martin, as an institutional investor, if perhaps, or a provider of product for institutional investors, if you could introduce yourself.
Yeah, sure. Glad to do so. My name is Martin Opfermann. I head up the trade finance team here at Allianz Global Investors. Allianz Global Investors, we're a fund manager belonging to Allianz Group. And as such, we're obviously very interested in the asset class and the growth of this market for institutional investors.
And last but not least, Nils.
Yeah, hi, I'm Nils Behling. I'm the CEO at Tradeteq. We provide a marketplace for private debt and real assets, and we allow investors in these assets and originators in these of these assets to very efficiently connect, to interact and transact. And what that means is that we provide them with securitization as a service. So everything they need to very efficiently issue notes out of compartment, analyze, get all the reporting they need around that. We have been at that for about 6 years now. We have issued about $2.2 billion of notes out of our vehicles, processed about 29 billion worth of instruments, or if we want to count them, that would be sort of around the 7.58 million mark of individual instruments.
Okay, so that's pretty helpful. We've got a fairly diverse group here. Before I was working for an IFI, I was also an investment fund manager, and before that I was a bank trader, so I'm able to disparage bankers because I was one. So I think that's fine. I'd like to open up the questions firstly to Martin. Martin, what are the positives of supply chain finance for institutional investors?
Yeah, obviously there's many reasons. I think it comes down these days to 4 main reasons. The first one being attractive yields over cash or other short-term investments. It really pays a pickup for illiquidity and complexity premium. The second one is the short duration, which is appealing because we are still in a rising yield environment, and that obviously people are scared to lose mark to market on their fixed income book. And the third one is it is a self-liquidating asset class, which is quite unique. It doesn't need to be refinanced in capital markets, but self-liquidates, and that is appealing to investors because we are at the beginning of a credit downgrading cycle, and where a lot of credit issues may arise in the future, and having something that liquidates is obviously highly attractive. The fourth point is really about the correlation. In a portfolio context, investors are always looking for assets that are not correlated to everything else they hold, and that is particularly true to trade finance and supply chain finance, which after a year of 2022, where both equities and bonds have been down severely, while supply chain finance was up and stable, this is obviously a very, very good feature for investors.
Okay, so it's pretty obvious that they've got all the attributes of something that should be extremely attractive to pretty much all asset managers. And particularly after the last year when we've seen increased volatility in asset classes and people and asset managers tending to run more cash, which until recently didn't yield any return on their portfolios. So as far as that's concerned, it's a very attractive asset. And of course, we have to go to the question, if it's a very attractive asset, why isn't there more of it? Why aren't we doing more? Why aren't we seeing more of this? So I'm going to turn to Jason Barrass at this particular point in time, because in one of our preparatory sessions, he pointed out the need to translate trade finance receivables into the language of fund managers. How do we make the product more attractive to institutional investors? And can you expand on the point of how ARC ratings fits into this?
Yeah, great. So having spent 25 years in various different product areas in trade, we love our terminology. It's one of the great things. I think we kind of like make ourselves clever by confusing other people. So there's red clause, letter of credit, green clause, letter of credit, irrevocable guarantees, and it goes on and on and on and on and on. If you try and take a transaction to someone who doesn't understand our product, okay, and you talk around how something is self-liquidating every 90 days, and it's an irrevocable undertaking, the average investor, and I'm talking about pension funds, etc., insurance companies, will not understand that. They'll look at trade finance, and it's baffling anyway, and they'll scratch their heads and say, you know what, I'm going to stick with different alternatives. Maybe I'll invest in renewables, in solar, etc., etc. So the great thing around, for me, who spent all this time in trade finance and then moving into different forms of capital markets, is how do we take this wonderful product that we've got, and it really is amazing. Default rates are like tiny, and if you look over like the last 20 years, even though we've had some defaults, compares nothing to the likes of Enron and other forms of transactions like that. The asset class is performing very well. The yields are great, and it continues. So, it's not going to stop. Trade will continue and continue. So for me, intellectually, translating this great asset class and what it looks like and putting that in front of a pension fund or an insurance company and put it into their language, that is the really, really fun part, because in our company, we actually know the terminology, okay? So we can basically then turn that into something that the investors understand, which is AAA, AA, single A, triple B, double B, et cetera, and we basically say this asset class has been looked at by a regulated, independent credit rating agency, and we think it's investment grade at triple B. They then understand this. They understand what triple B is. They can actually then relate that to another asset, and that for them is the starting point. So that's where we fit into this whole kind of like ecosystem.
Okay, it's a fairly comprehensive answer. So we all reckon it's a great product, and there is an imbalance that needs to be funded, and we've identified institutional investors as being the people who can do it. But what more can be done to educate investors on the asset class and its benefits? I'll open that up initially to Martin.
Well, one thing is about the definitions and words used, as pointed out already. The other point is around explaining what also went wrong in the past in this asset class, because there have been failures of investments, and I think that's something where probably more time is needed to explain that, and more general interest is needed. Those 2 points I would see.
And Nils, as a person who operates in a platform environment, what do you see as being the major challenges? What do we need to educate institutional investors into the asset class?
Yeah, I think all the points that have been addressed, the general understanding, what's going on here, the terminology, as already said, it can be very confusing. It's not only confusing between institutions, but the same institution operating, say, out of the Middle East and London will have different terminology for the same product. So these things require a bit of standardization. I would say there are great initiatives out there that try to deal with this. One I would highlight here is the Trade Finance Distribution Initiative, of which we are a founding member. That's a group of about now 70 large, and the very largest actually, global asset managers, banks, originators of trade finance that have come together with the goal of making this asset class investable, really opening it up to non-bank investors. And the banks, of course, have an interest in that as well, and I think we'll touch on that. We run all sorts of events, panels, podcasts. I think Martin has been on one of the podcasts before. So it's definitely something that is a fantastic initiative and that tries to bring together the relevant players in setting these standards and disseminating information and bringing about education.
Yes, and the reason I've actually left Kaarel for last is I know that it's a pet subject of his, right, which is capacity building of investors, right? Do you think this is something that is warranted in this particular area?
Yeah, absolutely. And I mean, Martin made a good point of why it's actually a good, or why it could be a good instrument. But I was a banker in my previous life, and I fully agree that the terminology, I mean, it's not for average Joe. So it needs to be, I wouldn't believe that I would say it, but it needs regulation, it needs some kind of standardization. And the last panel was talking also about over-regulating. And I think this is a threat. It's a worry, definitely, that I mean, in terms of capital markets, look at what the European Commission is regulating. Very often it's either over-regulating something or discussing something for so long, it polishes all the corners, so the end product is nothing that it started. So I would say simplify for the investor, because given the good performance and the underlying of this service or product, I mean, it would make a great offering, in my opinion.
So it seems to accord very much with what Jason said earlier. But I'm going to open it up to Martin, because in one of our earlier conversations, Martin estimated that asset managers only account for about 5% of the financing of trade assets. How do you explain this percentage? And is this more difficult in spite because of the collapses that we've seen recently, most notably the Greensill Credit Suisse collapse? What lessons have we learnt from this about the asset class? And you know, what are our takeaways from this collapse?
Yeah, very many questions. I mean, obviously, you're right. I mean, whether it's 5% or less or more, a little bit more, it is the predominant part of trade finance, global trade finance, is still with the banking industry. The part of the non-bank participants is growing, but it's still very small. And this begs the question, why is that so? And I mean, there are the advantages, but there are also the challenges. One point we didn't touch on yet is how to access the asset class. I think we'll come to that later. And the other thing is what has gone wrong in the past, and is that already well enough explained? Greensill Credit Suisse, the funds that had to shut down, some of them with severe losses. I think that was widely publicized in the media. So the collapse was well covered by media. What was less covered is sort of the untold story of what I call the untold story of the Credit Suisse funds. Because if you remember, they had 4 funds, in total around 8 billion when they shut them down. And 2 of those funds were just doing investment grade with no credit insurance attached. They had hard selection criteria, and the instruments in there, they were all diversified. And these 2 funds, a little over 1 billion, they recently repaid in full, almost in full. I think one of them, and this is all public data, you can look it up in the press announcement from Credit Suisse, if you don't believe it. One repaid 99.5%, and the other one, I think, 99.7% of assets under management of these funds. So it was basically a full recovery after what was elsewhere a disastrous outcome for the other funds. So why do I mention that in so great detail? Because a lot of things, obviously, in the setup of those Credit Suisse funds and the structure that Credit Suisse and Greensill operated together was flawed, and it shipwrecked. But underneath that, there's the untold story. The asset class, these assets, these trade finance investment grade assets, they performed exactly as they should. The funds repaid within several months after closure, almost all their investments. So the money came back as planned, and the amount came back as planned. So it was really an asset class that, despite all the challenges of the structure and everything, performed perfectly in line. And I think that is the story of, this is the untold story of the Credit Suisse situation.
And I know Jason's got a couple of comments on this, right? So one, just for those that are unaware, obviously the Greensill collapse was fairly significant. And one of the issues that was related there was counterparty overexposure to a particular segment. But generally speaking, what can we do to mitigate against these types of collapses in the future? And what role does ratings have in this?
So it's always interesting. You look at these collapses, invariably you find that there's an element of fraud involved, right? So if you look at the Greensill, again, great assets underlying it, what the team there did, they said that it was all going to be trade. It turned out not to be all trade. There were fictitious companies, etc. That comes down to human interaction. So, Martin's very correctly separating out the proper trade assets with the bad behavior, which is driven by individuals normally. And unfortunately, quite a few of the losses that we've seen around the world in trade, which get all the headlines, okay, are down to fraud. You look in the Middle East, there's a few there, a couple in Singapore as well, right? And that doesn't happen in a lot of other asset classes other than loans, okay, that you see when an investor's investing. So if you look at another asset class that an investor may put some money into, let's say non-performing loans, there's an assumption in there that there's going to be losses, okay, and that something's going to go wrong. If you look at mortgages, again, assumptions, credit card assumptions on losses, etc., etc. But what we make the mistake of doing in trade is, one, we don't structure it properly. So we'll analyze the credit risk, brilliant. But if you want to attract an investor and issue notes, okay, you've got to have some comfort. The structure that you've built has an ability to be able to absorb losses, okay? And that's where the structuring comes into doing this. Our industry is inherently old-fashioned. It hasn't changed for the last 300 years, okay? We haven't embraced all the other products that there are in banking. So unless we do that, then we're going to have these problems coming again and again, okay? So, my message here would be, let's wake up, let's start to use some of the other banking tools that they've got, structure transactions properly, okay, make sure you can absorb losses, and then you start to bring in alternative investors.
Okay, I think we'll focus on that a little bit later on, to be perfectly honest. But Nils, do you have any additional comments to make on the collapse and its impact on the industry?
Yeah, I agree that risk concentrations, overexposures are nothing that is particular to trade finance. On the contrary, I think what Martin said about the quality of the asset class when it comes to especially to investment grade trade finance, which is a very large part of what's available to investors, bank and non-bank investors alike, that really performs very well. I also agree that the structuring bit is important. I would add another dimension here is, if you deal with these exposures, one feature that we have not necessarily touched upon, especially in the investment grade space, is that they are typically low yielding. And in order to get the diversification, you will very quickly deal with very large number of exposures. And we heard about the self-liquidating nature of these. They can be very short term. Now, what does that mean in terms of processing? And that's sort of where I'm getting at with this. Of course, you can try to run this on a spreadsheet, but you very quickly, unless you throw large amounts of labor at it, you'll very quickly hit a ceiling. And I think that's where technology, and that's certainly what we're seeing, where technology can play a big role in order to make sure that you select the right assets, that you keep your diversification, that you keep your portfolio criteria, selection criteria, and so forth. And a platform like the one that we're running is providing exactly that service. And I think it's a critical element in order to maintain discipline, quality, and avoid collapses like the one that we've seen with the Greensill.
Okay, good points. So basically it's technology and giving the investor what they want, right? And if we can actually, achieve that, the asset class will probably stand scrutiny all by itself. Now, Kaarel, we have you here for a very specific reason. As the CEO of a stock exchange group, what do you see the role of an organised exchange in building this asset class? And can it go beyond bonds and funds? Would a listing of Greensills have avoided any of this problem?
Good question. Let's go back, I think, a little bit and look at the broader picture. Let's go back to 2008, for example, when the financial crisis hit. one would say some companies are still feeling it. So I think it was clear then that the countries that were the most bank lending based, our country, the Baltic region, the most got hit the most. Because why? I mean, obviously, it was a banking crisis. So I think since then we have seen clear focus from the European Commission towards developing capital markets. We have seen some numerous initiatives like the Capital Markets Union, etc. So what we've seen is harmonization, standardization of much that is about capital markets. Have we developed as a region? I would say yes. Is it enough? Definitely no. We are still incredibly bank lending based, and we clearly lack instruments, especially for the institutional investors. I think also for many people in the audience, it would come as a surprise, perhaps, or news at least, that in our stock exchange, it can be mainly described as a local retail exchange, meaning it's very much dominated by what the local retail is doing. We've seen tremendous growth there, but what is really lacking is foreign investors and institutional investors. And on the institutional, I mean, it could be also foreign, but I'm mainly referring to local pension funds. What is the pension fund looking for? A sizable, high-quality instrument. And as far as I understand, then this supply chain financing instrument could be bundled into something that would be sizable enough and with relevant ratings, also very attractive for parking money for the pension funds. Because looking at the very short-term nature of it, it wouldn't make sense to list anything, I think. But when you really find something that is, I think maybe bundle is the best way to describe it. And also it has to be understandable, because when you really need to go into very much detail, what does it mean, how does it revolve, what is the underlying asset, etc., then it becomes too, it loses the appeal, simply.
Okay. Jason, you got any thoughts on this subject?
Yeah, I'd say in theory it's possible to bundle many obligations and as long as they're suitably structured. I think one of the ways that the European investors would come and get more involved, specifically what Martin said about the low yields, in the asset, would be that if they could maximize the use of their risk-weighted assets and the capital. And again, one of the ways to do that is to have your receivables, your payables, have it in an SPV kind of vehicle, and then with a rating on top, then there's capital saves for investors in certain countries and markets. And that basically means that when the German pension fund invest in that asset, their returns actually increase because they have to put less capital away as reserve, Basically, it's cost of capital, right? And, again, it's getting into this way of thinking how we utilize other products, other knowledge in different parts of the banking market to actually make it attractive to new investors. If we continue just to sell under a risk participation agreement a trade asset to another bank, they're going to be the same returns and they're not going to be attractive. But if you get clever about it, then they become attractive.
Okay, I think that's a reasonable summary of what the challenges are that we are confronting. This is a short-term instrument, and there are short-term instruments that institutional investors will buy, such as commercial paper as an alternative to cash. But one of the things is if we're going to make this a fundamental asset class, we need to look at structuring and improving the structure going forward. It's not just the short-term nature of it that is attractive for some investors is actually not that attractive for pension funds and other asset managers. Just because we are in the Baltics, right, we have to have a follow-up question to Kaarel. What are investors looking for here now in the country, given the geopolitical environment, etc.? And are they trimming their exposures, or is it just the foreign investors that are trimming their exposures?
Again, let's take a short excursion to history. I think we have seen this trimming of exposures since the 2000s, at the beginning of the 2000s, when really some of you may know, some of you may not. It's a bank called Hansa Bank that is now Swedbank. When they exited the market, then basically the newspapers headlines said that you can also now close the Tallinn Stock Exchange because all the investors are gone. Well, luckily we didn't close, and I think we've come a long way since. But what is still true is that the institutional investors really did pull back, and I wouldn't say it's because of the geopolitics that it's any more severe. I think it's pretty much the same. And what I said earlier, that it's very much a retail dominated market. This was also before 24th of February last year. So no big changes there. What we've seen is that whenever we carry out a sizable, successful, visible IPO, reputable management, all the, tick the boxes for a successful IPO, we see clear interests from foreign investors, like also EBRD, and also other institutional investors, including pension funds. So for us, it's really a no-brainer. What do we have to do? We have to have an instrument that is sizable enough. And sizable enough in our market means 100 million already. So because a pension fund, what do? No more than 10%, it's already 10 million out of 100. So it has to be somewhere north, I think 100, the higher the better. So and the structure again, I think it needs to be really structured well. And I was very glad to learn about your expertise to give these ratings. So yeah, long story short, the situation really hasn't deteriorated because it was already bad in terms of this balance between retail and institutional. But definitely it's not helping the geopolitics. I mean, talking to large IPO prospects, they are not even going on roadshows now. Abroad, I mean, because it's just not viable. It's too difficult to explain the geography and everything around it. So again, a product like this maybe could be very interesting to balance.
But I think you're basically saying that any product would be helpful, but the more products, the better, basically.
Absolutely.
Yeah.
But I mean, the mere characteristics of these products, they are really the same, whether it is an equity product, bond product, fund product. It needs to, again, tick the right boxes, and then you get interest.
Okay, so we've actually covered a bit like the landscape of what needs to be looked at to help the institutional investor bases. But there is something that's very optimistic in this industry, and this is the fact that it's a big embracer of technology to try and support what is huge and growing global needs. So, the question to the full panel, and I'll start with Nils, seeing he's on the platform, is what fintech opportunities are we exploring? I heard today about tokenization of securities fully backed by trade finance, and barely any discussion at the moment in any industry occurs without the word blockchain rearing its ugly head. Can you describe what we're looking at and what technological advantages we're presently focused on, or which ones you present the best opportunities to facilitate the conversion of this asset class to something that's attractive to investors?
Yeah, I think where technology can
We've lost you, I think, Nils.
Trade finance in a related format, actually. I think that's the important giveaway here. But that aside, and I think for that to scale up, there might be a bit more time needed, although we're working with the only trade finance focused blockchain in that space, the XCC network, very successfully. But that leaving sort of that aside, I think more generally technology can help all these features that also Kaarel touched on. How do you bundle? How do you make these assets, these heterogeneous assets, understandable? How can you make sure that when they roll up, when they self-liquidate, that you're not sitting again in cash, but that you replenish your portfolio with like assets and keep it rolling it forward, because only then it becomes really an asset that is interesting for a pension fund that wants to put 100, 150 million and more to work. And that's where technology can help to facilitate all these things: asset selection, monitoring of assets, flagging if there are issues in the portfolio, the replenishment. That's where I think that's sort of the biggest touch point for technology that I see. And that combined with the ability to repackage into notes that can be bought by investors, so that they do not have to go and buy each underlying invoice. And the portfolios that we're seeing, certainly those have tens of thousands of invoices, sometimes more. You do not have to buy each of them. On the risk participation is something that technology can facilitate.
Okay. Also, let's face it, trade finance used to be a very, very paper-intensive industry. So anything that reduces the paper intensity of the industry will immediately lead to its growing efficiency, I would have thought.
Absolutely.
It still is paper-intensive.
It's still paper-intensive.
So I mean, I left the Middle East 2 years ago, and just walking through the trade operations department, you had like piles of paper that high, and people working through it. And whilst they may then scan it into a reader, that's not digital.
Yeah.
Okay. And I think the role that technology has to, Sean's here, right? Knows a lot of what's happening in the digitization process, but it has to be a complete end-to-end solution. If someone comes to you and says that my back end is digitized and it's just literally scanning something and then storing it digitally, that's not. And also, how do you know that it's real? I was talking to one of your conference attendees today, and they're looking at kind of like cutting edge technology, which actually really does prove that the asset belongs to you. So at the moment, what we're finding is there are so many different technology partners out there and they're doing different things. And it's all these little kind of digital islands, and they're all connecting together, and it's like a big spaghetti mix. It's not coordinated.
This is a very much a related conversation, because I, in my spare time, also look at central bank digital currencies, and they look like the solution to the end of the world, right? They should be great for remittances and everything else like that. But without even trying, I counted up 100 different initiatives in the central bank digital currency space. And so the first challenge will be trying to work out which one works, and then the second challenge will be getting everybody else to actually turn around and agree. And it seems like trade finance is going down a similar highway, I think. Any comments from Martin?
On the technology point of view, or on the barriers to entry point of view?
Technology.
Well, I can sort of relate to the points. What a lot of industry participants are facing. For us as investors, basically the question comes down to finding assets every day of the month to fill up the portfolio, because the assets run off so quickly. And with that, we are very hands-on and transaction focused. So we don't care about which technology, which format the asset comes in, as long as it is available for us to purchase. So we have taken a very opportunistic approach because we are confronted with a situation where every one of our counterparties is working on a different method, platform, legal framework, product type, operating platform, and so on. And today we work with 20 different sourcing partners, as we call them, and everyone works a little bit differently, be it the legal format, be it the product that legal format represents, be it the operations of purchases and replenishment, be it the cash flow management, be it the KYC. So our strategy was to adapt to what is out there and to rather focus on the assets that we want to buy, rather than limit ourselves with selecting a technology that is then not uniformly adaptable, uniformly usable for all partners.
Okay. Now, we've seen in other going back to Jason's earlier point, right? We've seen securitization being used very, very effectively in asset classes, and particularly credit cards and account receivables securitizations, which are intrinsically very short term anyway. So trade finance cash flows should fit into that type of instrument. Is that a structure that's worth pursuing going forward, Jason, or is there anything else?
Very much so. So every year I go to a conference, excuse me, called Global ABS. It's down in Barcelona, and it tracks 5,000 insurance companies, pension funds, banks, fintechs, etc., etc. First year I went to it, on the morning of the first day, there was a panel about trade finance receivables. And I went in there and there were literally, 100 people out of the 5,000. The second year, there was about 400 people going. And the conversations that I personally have with investors, because part of my job is to actually talk to investors, they like the asset class. Okay, it has invariably good returns if structured correctly. And the way that they normally work is as a percentage of their overall fund or pool that they can put into alternative new structures. And this ticks all those boxes, but they just need to understand it. Okay, so part of that process, as I mentioned, is translating what the trade pool is into language they understand. And just going back to points Martin made, when we do a rating on a trade fund, for example, I'm not just looking at the credit risk. Okay, I want to make sure that I understand the operational risk, the use of technology, how they mitigate fraud, how experienced the managers are in doing this. Are they brand new to trade? Do they know, have they been through a cycle that's lost money and what have you? Because ultimately the investor wants to have comfort that that triple B rating, okay, will survive. Okay, triple B shouldn't be falling down. Okay, and that's why I think this asset class is perfect to actually fall into that group.
Yeah. All right. So, Nils, are platforms the optimum structure to build a pipeline of assets in this area, or is there some? Normally, what happens is the banks start their credit card receivables securitization from their own credit card assets, where they know the client. Are platforms the right venue to try and source assets to build securitization based on trade finance receivables?
Was it Nils?
Nils.
Oh, sorry, I think my internet had a little break. Yeah, I think platforms are a good sourcing partner. For that, there is a large amount of these platforms out there, and everyone will add something slightly different, as Martin described. I think what's important, at least for our clients, and we work with some very large asset managers in this space, is that they get some normalization and that the sourcing from different platforms becomes comparable to each other, so they understand what actually is in the packages. I think the securitization is a very good structure. In the last year alone, we have issued over $1 billion US worth of notes out of our Luxembourg vehicle. That's not a securitization in the tranche format. Most of this is just repackaging, but that's sort of almost the straightest line to the goal between a large pool of invoices and an investor buying this large heterogeneous pool of invoices. I think securitization per se, we'll see more of that. Ratings will be more important, and once we have the ability really to do that very efficiently, that will tremendously increase investment in this area.
Okay. Now, turning briefly, we've got platforms as supplying the assets. We've got the knowledge of banks, etc. And a key issue in all of this is KYC regulation and KYC requirements. You know, I'm not sure whether you guys saw the earlier presentation about the state-sponsored solution for KYC that is being experimented here in Estonia. Did you see it, Nils or Martin?
I haven't seen it, no.
Okay.
Yeah.
Then I will flick it straight across to Jason and see what your initial thoughts are. Is this something that is going to be value in KYC, or is it an Estonia-centric solution?
It's a key risk in trade assets. So if you're Credit Suisse and you've invested in a pool, you would be horrified to find out that KYC was not done on trade assets. As an ex-banker, it was drilled into me I probably spent 10% of my time doing online courses around KYC. It was a nightmare. I hated it at the time, absolutely hated it. Now I've got out of banking and I go to see some smaller clients, and the concept of KYC doesn't exist. It's a Google search. And so consequently, you could find that there are transactions being originated by, could be Russian oligarchs, could be, anything which has reputational risk, okay, for an investor, okay? And one of the things that investors don't want is rep risk, okay? And so KYC is really key. Now, the problem comes with KYC is it's very expensive to do. So if you're a banker and you're running a client's KYC every year, I think from memory it was about, Sean, 40,000 to run a KYC on a client. That's a lot of money, right? And so we've got to work out ways in which we can do KYC properly and make it digital, using AI in order to do it, in order to scan and get information, and to make it cheap. I know that the French regulator was looking at KYC for banks and just having one standard set of KYC requirements, which were presented once and then given to all of the banks. That makes sense, it saves costs. But I really do feel that digitization, okay, can play a key role in getting KYC, making sure that it's secure, that it can't be played with, and this is where the B word comes in, blockchain or whatever, in order to do that. But that's a key part of attracting investors.
And Nils, I recall that you said there were some quite sophisticated approaches to KYC issues by some of the platforms. Have you got some examples there? Or was that Martin? I can't remember, actually.
Yeah, we're ourselves are not providing these solutions. I think this is definitely something that will see expansion. It is very, very important in dealing with banks. Banks see trade finance as a high risk area, especially if you deal with the parts of the bank that are not active in trade. So it will oftentimes raise red flags. So I think doing the right checks and utilizing technology to the maximum is really important, because the technology and AI, machine learning solutions, all this can help drive down the cost, because again, we're operating in an environment that can potentially be very, very stable, a very, very good credit quality, but with extremely low yields. So every basis point almost counts.
Any comment there from you, Martin, or do you think it's all been covered by the others?
Most of it is. I mean, I can only add from my side, for us, it's again a very heterogeneous area. Every approach we take is a customized one with a sourcing partner. It really depends on how we fulfill the requirements that are on us. Obviously, the requirements from a regulatory point of view, they are all the same, but the way they are fulfilled is sometimes in nuances a bit different. So we go at great depths to analyze how each partnership is set up and how each KYC process will work.
And I think, if I could just add on this point. So if I'm putting my credit rating hat on and I'm looking at a trade fund which is sourced from a bank versus a trade fund which is sourced from a small setup, I'm going to invariably give a better rating outcome to the bank, okay? Because the bank will invest so much money into its KYC, compliance, and what have you. The previous bank I worked for, I worked 4 years there. On my first day there, I had the US, called the US Monitor, okay, come in and basically pull all of the trade deals apart because the bank had been financing money laundering and what have you. So the US Fed sees trade as a high-risk product, okay? So again, it just goes back to where are your trade deals coming from? What is the compliance setup within that organization, and how open and transparent is it? Key, crucial.
All right, so we think that banks have the comparative advantage in KYC at this particular point in time, but potentially the technology over a period of time could catch up fairly quickly, particularly as trade receivables becomes more and more digitalised, I would imagine. So I think that's a broad summary of it. Now, we've covered an immense amount of territory here because there's an immense amount of territory to be covered. But if there are any questions after the next little question that I'm going to ask all panellists, I will have a look at the questions and ask them to the audience, but ask them to the panellists, right? But, besides blockchain, the one thing that every panel tends to get asked about is ESG benefits. And there's been a lot written about ESG benefits of providing finance to suppliers using deep-tier supply chain finance channels. Is this a reasonable goal, or is it a dream? Is it a pipe dream? And from a practical point of view, how far down the supply chain can you go to have a reasonable comfort that your ESG goals are being supported? And I will open that up to all the trade finance professionals. Well, and I guess we could probably start with Martin.
I would start very, very generally, not so much with the size of the supply chain participants, but more in general. I think trade is good. It helps fulfill certain ESG ESG targets such as inclusion. It has the ability, if it's international trade, to reduce the inequalities that are around in the world. So there's more of it is better than less of it. That's for me is a big ESG benefit of the whole industry. And then if you establish certain policies in ESG to not do certain sectors or certain types of activities, or to assess or integrate them into your analysis framework, I think then you can achieve these ESG goals. But as with every topic that we've touched on today, there are so many different ways to approach ESG in general. So it's not one fits all.
Yeah, absolutely. And I suspect that the ESG principles will be, they need to be traded off by a lower financing charge, right? So I imagine, right, that given it's a low-yielding asset anyway, that's going to be one of the challenges. Would that be correct?
True, yeah.
Yeah, it's still you. Sorry.
Yeah, maybe I'll pick that point. So, first of all, the statement I make is ESG is good. Now, there's a however, okay? There's no common rule book for ESG, okay? It's like turkeys voting for Christmas, okay? Your ESG grade 9, okay, may be the equivalent of my ESG grade fail, okay? And you can't have companies basically go out there saying, okay, I'm ESG for my supply chain finance program coming out of India as an A. There has to be, to start with, a kind of like common rule book around this so that we have commonality. To answer your second question, there also needs to be a financial incentive, okay? And you need the regulator to basically come in and say, okay, as a regulator, what can I do? I can't make you lower your pricing, okay? But what I can do is I can give you some capital relief so that it makes the returns look better. That could be a way that the regulator could give that incentive. They haven't done that yet either, okay? And then I suppose the last point around how far can you go down the supply chain finance. I was speaking with an ex-colleague of mine from Barclays, and she set up this ESG rating for trade. And the way that it works is that the workers who are in, I think it's Kenya, making stuff, at the end of the day, basically have some form of iPad, okay? And they've structured it so that they allow the people to go into a room, okay? It's not monitored control, and basically tick boxes saying, okay, has your off-taker, let's say the off-taker is a European retailer, okay, provided you with adequate education? Are you paid below the... And so they're sourcing the data directly, okay, from the people who are being affected by poor standards. And I think that's where technology can also have a role to play. And, you know, you mentioned tokenization. There are so many banks trying to do their own tokenization in order to pass it down the supply chain. So somewhere between that, all that combination of things, if it can all come together, you can actually get the financial incentive, the right kind of technology to make ESG actual good.
Nils, any comment on this?
I agree with all these points. I think that generally the democratization of finance, trade finance, can be driven by technology and by initiatives like ESG. When you think about the trade finance landscape today, and you mentioned it at the beginning of the panel, Jim, there is a trade finance gap, and I have actually heard figures that go as high as $6 trillion gap. So let's say it's huge. And one of the reasons for that is that banks tend to focus on their top tier of clients, and everyone below that, for whatever reasons, gets not serviced. Of course, we have to make sure if you impose these ESG standards that doesn't penalize all these smaller, medium-sized businesses that are dependent on funding, that really need finance, and that actually create the majority of jobs, not only in developed countries, but around the globe. So I think if we can solve that, then I totally agree ESG is good and will actually help to get more funding to these businesses, create jobs in the local communities, and be a force for the good.
Yeah, it's an excellent point. Does anyone know how the ESG bucket was originally devised? ESG is the remainder bin, the non-monetary remainder bin on fund management. So originally it's three separate things. It's environmental, it's social, and it's governance, right? And they're highly interlinked, but they're also individual. So this goes back to the point that Jason was making. It is almost impossible currently to come up with a scale of rating for ESG. We're all talking about it, but we all talk about different things. If you talk to a green zealot, they'll say that ESG is all environmental. If you talk to somebody who's interested in corporate governance, they'll go, what about uniform boards? This has nothing to do with the environmental challenges. So there's a challenge in and of actually defining exactly what ESG is, and the market needs to do that.
Yeah, very good point. And for example, if we take the ESG matrix that Nasdaq is using and suggesting their listed companies to use, whenever I show it to people and I ask, what is here that is not important? Usually people don't come up with nothing. Because if you take the E things, the S things, and the governance, everything makes sense. Now it's a question how you bundle it together. And I read a good piece in Financial Times. It was, I think the heading was that the ESG is in crossroads. And this was pointing to this direction from the investor side, that investor has basically two choices, whether to analyze the investment in a way that they take the risks involved into consideration, whether I take the environmental risk, the social risks, and it all makes sense. Or you try to analyze whether the investment you are making into these companies, whether the company takes these into consideration. And I think already here it's a different ball game. And I think as long as the rating agencies give, as you said, different ratings for basically the same company, I think Elon Musk may be right that when he said that ESG is a devil incarnate.
Having said that, I know the regulators are looking at ESG ratings because they see it as, again, systemic risk.
Yeah.
So there could be some regulation coming which would bring in that rule book, which, as it relates to ESG ratings, which would be very beneficial.
It's interesting. That was the most asked question on the Q&A. Martin, you had something that you want to raise?
I can share. I mean, if you're talking about regulation coming into place, and I heard you make the point that the rules were kind of arbitrary, and the way people were analyzing the same risks and scaling it was very individual still. I can say this is a bit, the stage has moved on a little bit. In Europe, the regulation is now out there for the asset management industry, the criteria, what is a normal ESG fund, what is an impact fund, and so on. These Article 6, 8, and 9 funds, they have now been clarified and strengthened, the rules, and it is now much clearer than it has ever been, which requirements such a fund needs to fulfill.
Nils, any comments on this?
Yeah, I think setting these standards and clarifying what we're dealing with here then will allow us in the next step to programmatically look at these criteria, and very much like we take eligibility criteria today that investors set to help them, and I'm talking about technology here, help them to replenish their portfolios of these underlying assets. We can use then these criteria as well and make sure that your very large fund with very granular, small, self-liquidating, revolving underlying complies with these requirements. So I think the more clarity we have, the more it becomes a yes or no decision, which will then again help drive investments and scale. Okay,
I'm looking through the remaining questions on the app, and there's some quite interesting ones, but a lot of them they're not related to a lot of these areas, right? One of the interesting questions, and it was something that we haven't actually covered, is what about electronic bills of exchange or bills of lading? Is it an active topic amongst the investors, whether the trade documents could be a good supplement to the existing and attractive short-term asset list? Any particular comments on electronic bills of exchange and bills of lading?
Sorry, can you clarify in the sense of digitizing it or?
Yeah, sorry, in response to...
On Nils.
Sorry,
I can make a short comment here. Obviously, all good instruments and all good innovation here. I would say the critical topic that we have when we looked at this from an investment point of view is that the underlying legal regulation wasn't catching up to this yet. We hear now that some parliaments are debating the laws that actually are the foundation of these electronic instruments. So that's good, because obviously as investors you want the electronic instruments to be no worse than the paper instruments when it comes to legal enforceability and the likes. So that's coming along. For us, again, very hands-on. The instrument and the packaging, the format it doesn't matter. We need to see the assets, and so far, to be frankly, we haven't seen many assets offered to us from our from our counterparties that would come in this format. But we would be very open to buy them if they were attractively priced and suitable.
And Martin, there's a follow-up unrelated question, right, which has been specifically asked of you. What are the minimum requirements for asset managers to get interested in these types of portfolios? Are there minimum funding values, numbers of suppliers and program durations, etc., before they're justifiable? I think it's probably one that you could answer from the rating perspective also, Jason.
So the minimum requirements for investors to buy supply chain finance, is that the question?
It's the minimum requirements for assets to get interested in entire portfolios of trade finance receivables.
Oh, the entire portfolio approach.
Yeah.
Well, it's a combination of yield, the credit quality inside, the eligibility criteria, the amount of time we have to commit to it, and the operational complexity to manage and monitor. I would say those are probably the main drivers. It's a bit generic because it applies to pretty much all the assets we look at.
Yeah.
But it's really the combination. There's no one fits all sort of criteria. We have been so far less buying pools of assets or less analyzing pools of assets, because usually the upfront time investment is quite large, and we rather taken the approach of buying single assets and replenish them thereafter rather than large pools. That's more of our approach how we tackle it. Yeah.
Because the single assets would be easier to monitor too, wouldn't they?
Yeah. Also, the return on time invested of the team is for us a sort of easier. You invest the time, you get the asset. Whereas on a portfolio, you invest a lot of time because you analyze a lot of credits, a lot of structural elements, and then in the last third of your analysis, you find the hair in the soup that makes you reject the transaction, but you've spent already so much time. So that's a bit. It's really the economics of investing money is spend time and get output in terms of assets. Yeah.
And Jason, any comments on this from the rating perspective?
Yeah, so the clients that we speak to vary. So there's the largest client who's investing in trade assets has a portfolio of €500 million, okay? And it's a renewable program, so you have to keep on originating new assets to take out replenishment risk. I've seen some transactions as low as 40 million. So I think it does depend on who the investor is. If it's a large insurance pension fund with a big fund, then obviously they want to make it as large as possible. If it's a relatively small second-tier bank that wants to get involved in this, then the amount's going to be smaller as well. So it does vary.
Any comments from you, Nils?
Yeah, I think the Martin touched on a critical point here. If you want to deal with diversification, large pools of investors, then you need some standardization, because really the time you spend on analyzing can be tremendous. So this is exactly what we see with the investors that we work with. They actually do portfolios, but they very heavily rely on technology because they absolutely cannot spend the time on each individual credit. And of course, if you have larger exposures, then it's worth doing the credit work, but you have to be efficient if you deal with very granular pools.
And there was a related question, well, it's not exactly related, but it's interesting more than anything else. A comment by one of the audience was that SEB in the Nordics, not yet in the Baltics, has moved supply chain finance as a product out of trade finance and factoring into asset management. Do you see this as something that would be widely adopted by other banks in the region or asset managers? How big of an impact would it have in an internal setup on the availability of supply chain finance as an asset class? Any thoughts on that? They're not the first bank to do this, I must admit. I've seen several banks and several asset managers who've actually shifted this business away from the traditional trade finance area into specialist units. It's not the first, and a couple of asset managers I know have done exactly the same. But do you think this is a trend that will continue, or do you think it's still firmly going to be in the trade finance orbit?
Okay, well, let me give it a crack. If they transfer it over into asset management, it's solely because they want a feeder of assets into their funds. The risk is that you then have managers who don't understand the product. Yep. And in the usual kind of cycle whereby cost savings come, they start getting rid of operational people and compliance people and what have you. I personally would prefer to keep it in the trade area.
Martin?
I wouldn't have a view on how banks structure their businesses efficiently. I have to pass on this question.
Yeah. I'm not quite sure what that was. Does anyone know what that was? Okay, I think I've pretty much exhausted the questions from the panel, but from the Q&A. But are there any questions to any specific people on this subject? I know we've covered a lot of territory, but that's because there's a lot of territory to cover in this space.
Everyone's ready for glass.
Oh, we have one right in front.
Yeah, it's not a question so much as a sort of point of information about, Jason, what you were saying about relief for ESG investments for banks. That's something we've been looking at in ITFA. The regulators have said, actually, we don't want to give positive relief, but if you invest in bad ESG, if there are ESG features to your investment that we think are negative, we'll actually penalise you. So there is a Bank of England paper on this from last year, I think July of last year, and I think some of the other central banks are following the same tack. So they're saying, it's basically a stick rather than a carrot approach, unfortunately, because they feel if they incentivise positively investment in ESG assets, you're going to get distortion. Movement, you're going to get an unfair reallocation of funds. I think their position is not unreasonable, but it does make it difficult for banks to sort of positively favour ESG. But that appears, unfortunately, to be the position at the moment. So we're going to start some work on that within ITFA. The other thing is, as I've got the microphone, you mentioned, you talked briefly about digital bills of exchange. We've, of course, got a panel on that tomorrow, and that's been a big area for ITFA, as those of you who follow us know. Thanks.
My one comment about the regulation negativity is that that's very poor regulation. We'll tell you when it's bad without setting out any core principles is something that we wouldn't expect from a proactive regulator. Surely you would define some of the boundaries. I don't know what the others think in this, right? But that one struck me as being fairly nebulous.
Yeah, I mean, if you read...
I was on.
If you read the Bank of England paper, actually, they say on that point, they don't know. And that's part of the reason. They don't know what's good or bad. And it's, you know, it's evolving. So they want the banks to lead them. And unfortunately, this is, as you say, it's bad regulation. But this is how, unfortunately, a lot of regulation happens these days. Banks, you've got to tell us what works. If ex post facto, you've got it wrong, we'll penalise you. I'm afraid that is the way a lot of regulation works these days. But yeah, they don't know either. They don't know better than us. I would suspect, you know, if you've made a good stab at trying to work out what's right and ESG compliant, and there are a lot of difficulties, as Jason has said. I wouldn't have thought they would penalise you, but that's their formal position at the moment.
There is no universal agreement on what is good and bad ESG also, right? Which is one of the problems. It's a little bit too, again, it's melded three concepts together and trying to claim that they're one, which is a little bit of a problem. But the bigger problem is that no one really can define the boundaries of it. And I would have thought that consultation, right, with the industry ongoing is a more effective approach than just turning around and saying, we'll just wait until we don't like something. And that's the thing that we'll regulate against. I don't see that as being particularly effective. But that's a personal view of mine. Any of the panelists have a view on this?
Well, the geopolitics doesn't help at the moment. I mean, look at the share prices of oil companies, etc., and what's going on in this net zero asset managers union, and it certainly, I can understand why it's difficult to standardize it, especially now.
Yeah, I'm in a positive agreement with everyone. I just do a small plug for Sean. On our website, we've got Sean's long interview that he did with us recently, touching on various things such as digitization, regulation. We've got a separate one on regulation as well, and trade assets. So if you want to see Sean expand and talk more, yes, we do, jump onto the website because it's fascinating.
Okay, are there any other questions? Because then we could be finished this early if, and I'm famous for not letting any panels go over time.
Yes. And the mic, I guess you could.
Hi, I have a question. It's probably for you, Jim. Glasses. If nobody knows what's good and bad ESG, what needs to happen to determine it? How do you fill the gap?
Yeah, it's a good question. I think that some of it has to be defined by the market. I think that what we've seen at the moment is, I think that all of us will have seen instruments that we think, for instance, are greenwashing, right? And that the asset management industry has not been vocal enough about them as a general rule. I'm seeing something positive actually emerging at the moment because we're seeing a split in the asset management industry between those people that are just trying to satisfy the demand for so-called green assets. But then we're also seeing people that are taking a more radical view of it. It's a very slow process, unfortunately. And I think that the final answer will be somewhere in between, but certainly there does need to be some clarification about what we're actually talking about. And until we define the various elements of ESG, that's not going to happen. I don't know, Martin probably may have an alternative comment. I don't know.
Well, I wouldn't disagree I wouldn't agree with the notion that nobody knows what ESG is. I think it's more that a lot of people have their own view and they're not necessarily the same. Yeah? Around E, around S, and around G, what the criteria are, what the motivations are, and so on. So I think that leads to a perception by some that nobody knows, but I think it's more, a lot of people have a lot of views and there is no homogeneity in them, which one very practical approach is to start with the obvious sort of obvious things where there is consensus. For instance, we have excluded tobacco as a firm for all our investments, or we have excluded cluster munition for our investments and some other sectors that we just don't do, such as coal. Yeah. So there is a minimum consensus that many investors agree to, but then there's other areas that are highly disputed, and investors and citizens of countries just are of different views. Yeah.
Yeah, and I think Martin is actually, my phrasing was a little bit clumsy. I think Martin's is far better clumsy, that far better analysis, right? That, you know, there are differing views about what ESG is, and what it is to one person is complete opposite of what it is to somebody else. And that's part of the issue that we're going to confront. So I don't think a regulator joining into the mix is going to be particularly helpful either.
I would disagree. I would say that there is a need for the regulator, industry or an industry body of some form to do that. But the problem is, unless you have the regulator, you'll have arbitrage. You'll have counterparties trying to get around the rules, and, you know, so for me personally, I would love to see the regulator come in with a common rule book, and that can be in consultation with the industry, so the industry can say that's a good part, that's a bad part, but you know, you need that.
It should be in consultation, I think.
Well, it should be, yeah. It rarely is, isn't it?
It's one of the arguments there is that it opens up the discussion to a council of regulators, because this is a global issue. And one of the biggest things about regulatory arbitrage is what we've seen in Asia. We've seen several instruments issued in Asia, which I think the majority of asset managers don't feel comfortable with the branding of them as green or sustainability-linked instruments, and yet they've been allowed to be issued, and there's been no action for non-compliance with, you know, key KPIs. So, you know, this is a global issue. It's not just, you know, it's not just a European issue, although Europe is better at least defining general boundaries through the Commission. At least that's one positive of what they do. Okay, are there any other comments from the audience? We have 4 minutes to go. Right.
Perfect timing.
Okay, thank you very much. It's been a very full conversation. Unfortunately, you're not going to be able to corral two of the panellists because they're conveniently remote today, but I'd like to thank both of them for the time that they've spent on this. It is challenging doing a double panel like this, right? But thank you for your patience, and the comments of all the audience, and also the comments of all the panellists. Thank you.
All right, thank you as well on my part. Very good discussion, and on top of the planned topic of supply chain finance as an asset, we got a very good insights about ESG as well. So thank you again.